I'm Matt Kadnar from the Nebo Wealth Team. At the core of how Nebo personalizes portfolios for individuals in a efficient and scalable manner is how we think about risk. Risk for an individual is very different than risk for an institution. Risk for an individual is, am I going to be okay? Am I going to have the financial resources I need when I need them? And that's at the core of Nebo's optimization because what you need when you need it, in essence, is a financial plan. Then Nebo runs its optimization to produce the optimal portfolio to maximize the likelihood of achieving that financial plan in an efficient manner. So let's look at an example within Nebo. So here we have Homer and Marge Simpson. 60 years old, retiring in 6 years with longevity of 101. And obviously, that longevity is Marge, not Homer, and 1.6 million of current wealth. So we've covered the time horizon and the current assets. From the cash flow perspective, Marge and Homer have gone to their Nebo advisor and they've built a financial plan here in Right Capital, but we're integrated with a number of other financial planning providers. And so we integrated that financial plan, we imported that financial plan into Nebo. And so here we have all of Marge and Homer's cash flows. We added a couple different goals on top of what we have in the Right Capital plan. Homer, of course, he wants a pool, but it's just not a regular pool. He wants a donut shaped pool. And donut shaped pools are not cheap. They cost about $150,000. And so in 3 years, he wants to put that in the backyard. And then they also want a legacy for Lisa and Maggie. Obviously, they're not going to leave a legacy for Bart, but we also have a legacy goal that we've added on top of our Right Capital cash flows. We have a risk assessment. What Nebo cares about from a risk tolerance standpoint, risk tolerance is incredibly important, but we want to take the maximum loss that you can tolerate in a bad bear market, and then we want to express it as a constraint in the portfolio, either a max weight in stock or max weight in volatility. And so we all know Homer is a very aggressive guy. So at the start, at least, we're going to have a maximum loss of 50%. But we all know Homer will hit the panic button. We'll come back to that later. So from an investment selection standpoint, we can do one of two things. We can use Nebo to select a model from an optimal array of models. So here I selected the BlackRock Target Allocation Fund. We can also add in other investment options over here. We'll come back. We'll do another example at another time, adding in some private assets. But you can also see down here we also have a range of other outside asset business ownerships, concentrated stocks, held away assets, insurance, RILAs, FIAs, a number of other additional assets that we can add into the optimization. So from the portfolio design, this is where the rubber really hits the road. So we've imported our cash flows from Money Guide Pro. We've added on a couple additional goals, the donut shaped pool and the legacy. And what we created over here in this gray line is the wealth benchmark. This is the minimum dollars that Marge and Homer need in their checking account in order to achieve their goals. And so I'm going to include the legacy box here, and you'll see this line shift upwards as we incorporate a legacy. And so now with the right capital, with the donut pool, with the legacy, what we can do is we can select the optimal model from a series of models that maximize the likelihood of Marge and Homer achieving all of their goals. This framework is incredibly flexible. We can incorporate custom models from other third-party asset providers. And so here you can see the BlackRock 7030 is the optimal model in order to achieve the client's goals. And here's the breakdown of stocks and bonds. What we can also do is, so I mentioned before, one of the keys to our ability to personalize is that unlike a risk approach where the portfolio is tied to the risk tolerance questionnaire, here the portfolio is tied directly to the financial plan. So if the financial plan changes, the portfolio is going to change. So here, obviously, a donut shaped pool for 150 grand is a bit nonsensical. And here we're going to uncheck the legacy just as an example. And so now the plan has changed in a reasonably material way. And so now we rerun the optimization where Nebo will choose the optimal model from that BlackRock series. And what we come up with is now we've moved from the 70/30 portfolio to the 60/40 portfolio because the plan has changed. If we had taken away the donut shaped pool and the legacy and we had just rebalanced back to the 70-30 model, then Homer and Marge would be taking more risk than they need in order to achieve their goals. With Nebo, we provide the optimal risk alignment for the client's financial plan.